Hey everyone, welcome back to Corporate Decoder. Today, Granite Point Mortgage Trust Inc. GPMT just filed its latest 8K report, and I am seeing changes to director pay that could signal some interesting strategies. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is adjusting how it pays its board members. And the reasoning behind it tells us a story about managing future growth and shareholder expectations. So, what is happening here with Granite Point Mortgage Trust Inc. GPMT is that they've updated their director compensation policy. This policy sets out how much cash and stock the people overseeing the company get paid for their work. The big news tucked away in this filing is about how the board members themselves are compensated. On the 4th of June 2026, the company's board of directors, which is like the main leadership group, gave the thumbs up to a new and improved director compensation policy. This policy is all about paying the directors for their service on the board and its various committees. Now, let's talk about what exactly directors will get. Under this new policy, if a director is considered independent by the New York Stock Exchange, they will receive a yearly payment of $100,000. If that director is the chair of the board or a committee, they get a bit more, $160,000. This cash is paid out every 3 months. But it is not just cash. They'll also get what is called a restricted stock unit award. Think of these as promises to give stock for free in the future. At the start of each period they serve on the board. These awards will be worth $50,000. For the chair, it is $80,000. These stock units have a 1-year waiting period before the directors can actually own them, which is called vesting. On top of that, there is a long-term cash award given at the start of each board term too, also worth $50,000 generally, and $80,000 for the chair, with the same 1-year vesting period. The company also mentioned they will pay extra in cash and stock awards for the chairs and members of important committees like the Audit Committee, Compensation Committee, and the Nominating and Corporate Governance Committee. Now, to really understand why this matters, we need to look at how things were done before. In the old policy, directors got that cash retainer, and they received a stock unit award worth $100,000 or $160,000 for the chair at the beginning of their term. But here is the key difference. There was no separate long-term cash award like there is now. So why did they change this? The board made this move to essentially split what would have been the entire stock unit award into 2 equal parts. One part remains as stock units, and the other is now this long-term cash award. The main reason they gave for this change is to lessen the dilutive effect of the stock grants. What this means in plain English is that by not giving out as many new stocks or stock units directly as before, they are trying to prevent the existing shares from being worth less because there are now more shares out there. It is a way to manage stock dilution while still compensating their board members well. They also mentioned that no other major changes were made in this update. Beyond the director pay changes, the filing also covers what happened at the company's 2026 annual meeting of stockholders. This is where shareholders get to vote on important company matters. The meeting happened on the 4th of June 2026. The main agenda items were pretty standard for an annual meeting. First, they needed to elect 7 directors to the board who would serve until the next year's meeting. Second, shareholders got to give their say in an advisory vote on how the company's top executives were paid. Third, they were asked to officially approve or ratify Ernst & Young LLP as the company's independent auditors for the upcoming year 2026. Looking at the numbers on the 6th of April 2026, there were just under 48 million shares of the company's common stock available to be voted. The meeting itself had about 34 million shares represented either in person or by proxy, which is enough to meet the quorum requirement, meaning the meeting could officially conduct business. Let's dive into the voting results. First up, the election of directors. All 7 nominees proposed by the board were indeed elected to serve until the 2027 annual meeting. The table here shows the votes for each director nominee. For example, Tanuja M. Dane received over 18 million votes in favour, with about 1.5 million against and nearly 1.3 million abstentions. The broker non-votes, which we'll touch on later with other proposals, were about 13 million for each nominee. This pattern of strong for votes with relatively low against and abstain votes is consistent across all 7 director nominees. It seems the shareholders were content with the proposed leadership. Next, we have the advisory vote on executive compensation. This is where shareholders get to voice their opinion on how much the top executives are paid. In this case, shareholders approved the resolution concerning executive pay. The results show over 17.5 million votes in favour, about 2.1 million against, and roughly 1.4 million abstentions. Again, we see a majority voting in favour, indicating general approval. Although there is a noticeable number of against votes, which is common in these types of advisory votes. A significant portion, over 13 million, were broken non-votes. Finally, the ratification of the company's auditor, Ernst & Young LLP. This proposal passed with overwhelming support. Over 33.2 million votes were cast in favour of keeping Ernst & Young LLP as the auditor, with only about 395,000 votes against and around 436,000 abstentions. This strong endorsement shows confidence in the company's choice of accounting firm. And finally, let's glance at the exhibits. The key exhibit filed here is Exhibit 10.1, which is the director compensation policy itself, so we can see the full details of what we just discussed about paying the directors. There is also Exhibit 104, the cover page interactive data file formatted in inline XBRL, which is standard for these filings. Overall, this filing paints a picture of a company making deliberate adjustments to its governance, particularly around director compensation with a clear aim to manage equity dilution. This move suggests the company is looking ahead, possibly towards future growth phases where managing share count will be important. It's a subtle but significant signal about their strategy for long-term value creation. The director compensation change, specifically splitting equity awards into cash and stock components, is a move we've seen from other public companies trying to balance rewarding their directors with keeping their stock from becoming overly diluted. It is a strategy that can be effective in showing shareholders that management is mindful of the share count. What Granite Point Mortgage Trust Inc. GPMT is doing here with their compensation policy is essentially trying to make sure that the folks guiding the ship are incentivized properly, but also that the company's stock doesn't get spread too thin. The fact that they've explicitly mentioned limiting dilution is a positive sign for existing shareholders. It implies a focus on sustainable growth rather than just pumping out equity. The strong shareholder support for director elections and auditor ratification at the annual meeting also suggests a general level of confidence in the current path. In the broader context, Granite Point Mortgage Trust Inc. GPMT is in the mortgage REIT space, a sector that can be sensitive to interest rate changes and broader economic conditions. Recent news suggests that while they reported a Q1 loss, they beat revenue estimates, and there have been insider purchases. This new director compensation policy might be part of a larger effort to ensure stable leadership and a long-term perspective, which is crucial in a fluctuating market. The PSA/E ratio is around 28.9, which is on the higher side for this sector, so actions that support shareholder value and manage dilution are definitely watched closely. The risk I am watching is how this new compensation structure impacts attracting and retaining top board talent over the very long term. And if their strategy to limit dilution through this method proves effective in the face of potential future capital needs. What I am actually looking for is to see if these changes translate into improved operational efficiency and shareholder returns in the coming quarters. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.